Welcome to the Baguette Investor channel for a new video. Today I want to talk about something I learned, and as you know on this channel, my main goal is to share all the things I learn and the thing I discover every single day, week, and month. And in the recent days, I discovered a very useful and interesting indicator that I didn't know before, which is the market strength and how do you judge the market strength. And one way to judge it is the percentage of stocks above a certain moving average. So you pick, for example, the 500 stocks of the S&P 500, and you tell the computer to give you a percentage of stocks that are above the 200-day moving average, 100-day moving average, or 20 days moving average. So you can see the number of stocks that are in a short-term, mid-term, long-term bullish trend, and 200-day being the long-term moving average. I think it's the most interesting to check right now, but if you're a more short-term trader, you'll be able to see other moving averages. I'm going to explain to you about what I see. So most of you know the basic indexes, which is the S&P 500, the Nasdaq 100, the Russell 2000, the S&P 500, for example. In France, we have the CAC 40. But what's interesting is that indexes actually don't tell you a lot about the strength of the market, because there is the strength as an indicator. So you tell yourself, well, the indicator is going up, but it doesn't tell you how widespread the strength is in the indicator. You could have the top market cap stocks carrying the index, or you could have the majority of the low cap stocks carrying the index, while the big cap are actually flat. And that's a big problem, because in order for you to know if you should either in which segment of the index you should invest in, and if the odds are on your side, in order to know if the odds are on your side, you need to know if it's the whole market that's going up. So if you buy a random stock, it will go up and you will look like a genius, when what you're actually doing is buying random stocks that go up. And if you ape the market and buy a random stock in a market that's actually losing strength, what you're going to see is you're going to see it not working. And that's what's happening right now. So if you look at the S&P 500, we're going to compare it. I'm going to put the S&P 500 below so you can clearly see what's happening. I'm going to make it slightly higher. There you go. So here you have the S&P 500. And there, oops, sorry, didn't mean to do that. Right there, you have the percentage of stocks above the 200-day moving average. So this is the broad market. You have 44.87% of the stocks at the time I'm speaking that are above their 200-day moving average. If you can also see this number, you have, at the time we're speaking, 68.51% of the S&P 500 stocks that are above their 200-day moving average. And if you want to know this about the Nasdaq, you can, 58.82%. Sorry, my phone made a little sound. For the Russell 2000, it's 47.70, and the next two, we're going to check them later. But what I really want to talk about, we're going to compare both things equal. The number of stocks on the S&P 500 that are above their 200-day moving average, and the S&P 500 chart as it's looking. You can see there is a divergence in those indicators. You can see that since the COVID crash, both indicators were matching perfectly. The number of stocks started to go up, and the index was also going up. And after that, we saw another phase where the index was going up, but the number of stocks above their 200-day moving average, which means the number of stocks in the long-term bullish trend, is actually reducing, which means less and less stocks are in a long-term bullish trend, which means there is a silent correction happening. And what you need to understand is that in this phase, there is capital coming out of the market. Right now, money is coming in. When you have where my mouse is and where you have March 2020 to, let's say, February 21, you have capital coming into the market. And right now, there is a money flowing out of certain stocks. So the average stock right now is still very well positioned in the long term. There are still a majority, well over a majority of stocks that are above their 200-day moving average. But there is not as much strength as there was back in April, May 21, where, if you look closely, it was close to 197% of the stocks were above their 200-day moving average, which means that basically there was no stock that was not in a bullish long-term trend. And if you look at right there, the number of stocks that was above their 200-day moving average was 2%. So basically every single stock was in a long-term bearish trend. And the best moment to be in the market is, of course, in post-recession time, that you can also see after the 2008 big crash, where you had the same kind of pattern, where suddenly, in a very strong way, the market comes back to 100% of stocks above their 200-day moving average. So, which means that right there, we're at the bottom of the market in 2009, and there we are at the end of the recovery. And that indicator shows basically where you are in the recovery. And what happens during crashes is that, well, here you see that all the way here, it's a very good time to make money. And there, what we're seeing right now is a much harder time to make money, because actually fewer stocks are in a long-term bearish trend, and some stocks are actually even going down. And this is for big caps S&P 500. But if you look at the small caps, it's even worse. I'm going to plot below the Russell 2000 so you can see what I'm talking about. Boop. I'm going to compare IWM, new pane. There you go. You can see for the Russell 2000, it's even worse. You have only 47% of the stocks in the Russell 2000 that are in the long-term bullish trend. And the index is flat since the beginning of 21. So this is an indicator that the indicator is telling you we're in a range market. That means as much stocks are going up as stocks are going down. And you see it reflected in the numbers. There are 47.70% of stocks above their moving average. You can also do this for sectors. I'm going to remove this one and type in the XLK ETF. There you go. Up. This is the S&P 500 information and technology stocks above their 200-day moving average. It sounds a little complex to you. It's very, very simple. You take only the stocks from the information and technology sector, and you take a look at what percentage of them are above their 200-day moving average. And that gives you a very precise number, which is 72% of these stocks of this sector are above their 200 moving average, which is a long-term trend. And you see the same phenomenon that since April, the market is going up, but the number of stocks in a long-term bullish trend is going down. And if you look at another sector, we're going to take a look at this in big screen. This you can do this for every single sector. This is a materials sector, and you can see it's the same thing. We have the same phenomenon, that a divergence between what the market is telling us and what the indicators are showing. So this is very interesting. I think you really need to dig this in. There is also another indicator that I may talk about in another video, but I don't want this one to be too long. I hope I was clear and that you understood what I meant, and maybe you're discovering this indicator. So if you want to add these to your watch list for the whole markets, it's MMTH. For if you want to see what number of stocks in the S&P 500 are above their 200-day moving average, it's S5TH. And for NASDAQ, 100 number of stocks above their 200-day moving average, it's NDTH. You can add this to your watch list and take a look at how the market behaves around this indicator. I hope this was interesting to you. Hope I was clear. If you have any questions, please ask them below. And if you want to more of this information, subscribe to the channel and follow me on Twitter, where I post daily stuff and inform you about my daily positions. That's it. Hope it's interesting to you. Thank you so much for watching. See you in the next video. Goodbye.